All right, welcome to another episode of Cash Flow Conversations, where we talk about cash flow for people. Oh my God, I'm gonna start over. All right, welcome to Cash Flow Conversations. Today we have a special guest, Austin Hines, who is the owner of Skyway Financial, full service mortgage brokerage, offering offering diverse lending solutions for homeownership's dreams. And the part that I really want to dive into today is not necessarily the residential or your homestead, but rental properties, because we've seen a massive switch in that market in the last few months. Um, Austin is a proud father of two beautiful kids and a lovely wife, Kelly, and he's been doing this mortgage business since 2016, and before that, vice president of the largest owned veteran bank. Very cool. Great to have you here, Austin.
Yeah, man. Thank you so much for having me. I'm really excited to dive into some topics that I know you and I love chatting about. So it's going to be a fun conversation. I'm excited to get this documented with you.
Yeah, absolutely. This will probably be the first of a number of interviews because we've talked about a bunch of topics. Today, I want to focus on rental properties. We've seen a lot change in the last few years in the uh, housing pricing as well as interest rates and costs to borrow. So I want to go over some of the stuff that you've told me about, some tricks that people have used. Um, but before we dive into all that, real quick, let's go into some of your background. So you were part of that bank for how long?
Yeah, so before I started my own company, I actually was VP of the largest veteran-owned bank in the United States called the Federal Savings Bank, where we oversaw the majority of VA type products. During that time, I think at one point, they did an audit, and I had overseen close to 10,000 files at one point. So
Wow.
it was actually a really eye opening experience. We got to help a lot of veterans become homeowners and help them access equity in their homes in ways that a lot of people don't even know is available. And I think that was just kind of the beginning of my journey and to seeing how much a loan can really help you leverage your financial freedom, if you will, for lack of a better term. The reality is there's a lot of cool ways to actually put yourself ahead. It's just a matter of understanding the strategies and best practices to get you there.
Interesting. So when you were at the bank, you were a busy bee. Talk to me about the transition from W-2 to 1099.
Yeah, man. Ooh, it's always an interesting
Easy,
transition.
right? It's easy.
Uh, and what's funny is, so I come from a family of, W 2 mindseted people, which, if they're listening to this, love them, forever and always. But the reality is, a lot of what I've had to learn on my own has been how to navigate that exact transition, the one that you just mentioned. It's a tough one. In a lot of ways, the government doesn't want to make it easy for people to go out and figure out solutions outside of it. And the reason for that is W 2 income people are typically the ones who get taxed the most. So it makes sense to keep people kind of in that bucket. So I know I got off on a little bit of a soapbox there, but I want to make sure that I answer your question. So, specifically, you want to ask about me transitioning from being a W 2 to the
Yeah, because
brokerage handler.
it's not an easy transition, dude. I remember when I went from a W-2 to a 1099, and I called my mom after I got a master's in architecture. I said, I have a great job. It's 2009. We are plenty busy in our firm doing massively high-end residential projects. I'm going to quit. I said, I don't want to do it anymore. And she cried.
Yeah,
That was the support.
right,
And I'm going, well, should I be doing this?
right.
And 9 months later, I had doubled my salary doing something I was completely unfamiliar with, and it was called sales.
Yeah,
Um, and I never looked back. I told my mom I'd never do drawings again.
yep.
Architecture is beautiful, the profession not so fulfilling, and sales is extremely fulfilling when you help people get what they want.
Yeah.
So you said you came from a W-2 family, like so. When you're going, all right, honey, were you married at the time when you decided to do that into the 1099?
So my first step was actually I worked at AT&T in mobility sales. So I knew that I wanted to be in sales because I had a heart for it. I'm the type person that needs to chase the carrot at the end of the day.
Yeah.
But when you work at a place like AT&T, it's very much structured commission. Like they will continue to change their comp plan based off of, where those metrics are being hit and keep you kind of in a specific target like range of your income on what you're going to make.
Yeah.
And so what I realized was, I'll never forget it. I got pulled into a conference with my assistant manager at the time, and he during this conversation had a conversation with me about what my goals were. I was 23 at the time, and I told him by the time I'm 30, I want to be making six figures. And he was a super sweet guy, but at the time he laughed at me, not intentionally, not in like a mean way, but like in his head, that was just such a foreign concept that anybody before 30 would be able to make six figures.
Yeah.
And it was in that moment that I realized, like, okay, I've got to do something. I've got to figure out a way to get myself ahead. And so I started doing a little bit of research, and I realized that 90% of millionaires are made through real estate. And so I was like, I've got to figure out, I've got to get in this lane somehow. What's the best way for me to do that? And there was a company called Loan Depot. It was the third largest.
Company.
What's that?
Small company. I don't know if anyone's.
Yeah, they offered a very special opportunity at the time. I was one of the first ones out of the Nashville branch, where I had the opportunity to for the first 12 weeks. No, I'm sorry, 3 weeks. We studied for the exam. It was a 12-week program where I would study for my exam for 3 weeks, where it was nothing but us cramming for the test. And at the end of that, we would be commissioned loan officers. Still W-2, but I mean, at this point, we were making, double, if not triple what I was making at AT&T.
Wow.
And very similar kind of experience to what you were saying. During that journey, I remember the first 3 weeks. First of all, I'm a horrible test taker, and I did nothing but stay up 14 hours a night, literally rewriting our exam. It was like the thickness of a Bible, to be honest. That's how much curriculum we had to go through. Just bureaucratic nonsense, to be honest, because we ended up not using any of it. But that's, state exams.
That's what tests are for, man. You just got to fill up, take time, make sure you took it all.
But I remember the way the company was structured. If you fail that exam, you end up getting let go. And so there was a lot of pressure. I didn't have a backup plan at the time. It was pass this exam or don't have a job. And we just we just invested in a bunch of different stuff and purchased a home. So there was a lot of pressure on me to pass that, And so I remember I needed a 75 on it. I passed with an 82. And I remember I called my mom in the parking lot and I told her I passed it.
Beautiful.
And I cried. Like, I'm not really an emotional guy, but like in the parking lot, I boo-hooed like a little kid. And I need to go back. I need to go back because there's somewhere on my Facebook that I wrote some sappy post about sometimes you got to bet on yourself. And I need to find that and I need to frame it for myself because that was the first time that I ever did.
100% you do. When I realized I wanted to quit architecture, I went on Facebook and said, I need a new job. And a friend commented, come to Chicago and sell garages. And I thought, what does sell a garage mean? And what he said was, this is my pitch later on I developed. I said, I help the man develop the last room in the house that he can call his, the garage. So we do car flooring, cabinetry, car lifts, make it a real man cave. And I got to drive all over the suburbs and help people design their garages. But it was all based on a Facebook post. And this guy who I had met one time prior, I went out and visited him, met him twice. And the third time I saw him, I had a car full of luggage. And I moved in with this dude and his girlfriend and my dog. And we lived together for like 9 months until I found my own place and crushed it, man. We had so much fun. And I was like, well, this is so much cooler because I'm not bringing my work home. I get to control my income. Like if I want to make more, I just work on a Saturday and start calling for some prospects.
I love
And
that.
giving people what they want. It was great.
So you met him through Facebook, you said?
I met him through a mutual friend. We were young, okay, but it was a beer pong tournament at my friend's house. And yeah, at the time, my wife is probably going to listen to this, so hi, sweetie. But at the time, I was standing at this beer pong table, and there was this girl next to me, and I looked at this guy that I just met, and I said, who's that girl? He goes, oh, yeah, that's my girlfriend. I'm like, oh, okay, nice to meet you. And that's the dude, man. I stood up at his wedding. He stood up in mine. It was great.
It's funny to think back on that and reflect and realize, like, if you were to put a price tag on what that beer pong match meant for your life, I mean, that's a seven-figure beer
Oh,
pong tournament, you
eight,
know?
8 to 9, honestly, by the time we'll be said and done. And the cool part is, you don't know what you don't know until you get out of your comfort zone. We
Yes.
think this is our ceiling, and all I gotta do is just move out and get out from under that umbrella and just look up and go, okay, there's a whole new world out there. And just changing the perspective. I remember the guy, my old boss, who was a phenomenal dude. I'll tag his company in the description, Encore Garage. He said, I'm going to pay you $1,000 to move. A moving fee, bro. It took me like 2 weeks to make $1,000 at my old gig. I'm like, I am rich. I bought new shoes. It was great. Yeah.
I love that. Man,
Yeah.
it's interesting to hear entrepreneurial mindsets and just how they get where they are. It ultimately comes down to people betting on themselves.
Yes.
And, I don't know that that's what this podcast was meant to be, but hopefully some people can take that away from it.
It's
But
100% what Cashflow Architects stands for, is helping people invest in themselves. And so every
love that.
entrepreneur that I interview with this is, yeah, we're going to talk about cash flow, making money. It's all great. But the first step is you got to get out of your own way and you got to invest in yourself, not a government controlled asset, not what everyone's telling you to do. If you want to pay off your house, go pay off your house. Great. Good for you. But learn how to invest in yourself. And it's not always dollars. It's time, effort, and energy. Where am I focusing? And if I stayed at my old firm, I'd be making much less income than I do now, and I would probably be miserable. But it'd be secure, maybe ish. Jim Carrey has a speech when he talked on to a college after a graduation, and he said, his father was a CPA in Canada and was very conservative, and he used to make the family laugh, and he wanted to get people to smile. And his dad lost his job when he was 55 or 56. And he goes, here's a guy that did everything he was supposed to do for the career that was supposed to be lined up forever so he could take care of his family. He was conservative and he still lost his job. And that's when Jim Carrey thought, if I'm going to lose my job, I'm going to lose my job doing what I love. And I'm not going to go to college. I'm not going to be a CPA. I'm going to pursue what I want to do. And no one is going to sit back and go do that. You don't get permission to invest in yourself. It has to come from within, right? Like my mom cried when I called her. Now I show her what we're doing and she loves it. She's like, oh, I always knew you'd be successful. I'm like, I love you, mom, but did you? Because you cried when I told you I wanted to do this.
Yeah.
And
Yeah.
that's the motherly thing. Because they
There's,
don't want to see you fail. But that's failure is part of the whole journey. Imagine being 60 and never failing at something you tried.
Well, and that's the thing, right? Is the people closest to us, because they want to protect us, give us advice based off of their life experiences. And unfortunately, for the trajectories of where you and I want to go, I don't know about your social circle, but there's less people that are where I want to be than where I'm at, if that makes sense. I feel like I said that poorly, and hopefully we can
So
iron that out
say it
better.
again.
But
That's okay. Say it again. I think what you meant is there's people that are doing better than you in your circle.
yeah, well, let me use this example. I remember my dad was giving me advice once on where I wanted to go to college, and he had all of these opinions about what it was specifically that I needed to do and what my major needed to be, and he was like, if you want to be successful, you got to do this. And I
Hmm.
remember in just a moment of me being upset with him and frustration. My brother was also on the call, and he was being an asshole too. But I told both of them, I said, neither one of you guys are Bill Gates. At the end of the day, so like, I appreciate where your advice is coming from because I know that it's heartfelt. But the trajectory of where I want my life to be is not on the path that either one of you is at. So I have to take your opinion with a grain of salt.
Yeah.
And I know it comes from a loving place, but the reality is I gotta go and make my own mistakes in order for me to find success.
Yeah.
And I've bet on myself a lot. There's definitely been some loss along the way, but 9 times out of 10, when I look back on it, the wins outweigh the losses. So
It's a rate of return of happiness and fulfillment. Because and we've talked about this in the past, but if you fail or if you succeed, it's because of you, not anybody else.
I love it, man. Man, this is starting to feel like a mindset podcast, which I get more excited about that than I do sometimes even mortgage stuff. So,
Well, the intention of this podcast is to be somewhat of a mindset podcast because too many people out there want to do something, they don't know how to take the first step. And the intention of this is that every single person who's successful as a 1099 or entrepreneur had to go through that transition of, gosh, I'm supposed to go to college. Maybe I went to college. I'm supposed to get a job, but I kind of want to go do XYZ. And every person I interview is going, yeah, no one's telling you to do that. It comes from within. And if you can understand the empathy of other people going through it and then listen to their stories, like, yeah, it wasn't beautiful for a while. When I quit selling garages and started in the financial industry, my income went from well over six figures to like $20,000.
wow.
That's someone with a W-2 is going, you took a massive pay cut. But I didn't, because rate of return isn't just a dollar amount. Now look what we do, right? Like I can go take Thursday, Friday off and go hang out with my girls if I want to. So what I want to do is bring all of these successful people that I know and work with, these entrepreneurs, and have them exposed. Yeah, it wasn't always like that. No one told me here's what you're supposed to do next in order to make it. You have to bet on yourself. And then at the end of the podcast, we're going to talk about financial strategies. And that's basically what my book is about, and the financial course and everything that I teach is how to actually, with dollars, tactically invest in yourself so that you have leverage and can take advantage of these markets and your ability. So it is a little bit of a mindset podcast.
So paint the picture for me. If we take the average W two individual, let's just say typical millennial, because that's the average homeowner is probably around 33 to 36. Where do you think, financially, like, is a good starting point as far as, like what they should be investing their cash in?
So this isn't an opinion based. We follow principles, and I go over the principles in a lot of my education on cashflowarchitects.com. It's all on there, but it starts with the mindset shift that I am going to be my biggest asset. Me, my ability is my biggest asset. So once I realize that, how can I put my dollars in a place to back that statement up? If I know that my income is the biggest asset that I have, I want to insure my income. I want to get a little disability policy. So if I get hit in a car accident, my family's still paying the mortgage and I'm not working, but my family can still survive. And then it comes down to a place of how can I position myself to take advantage of the market? Dude, I was 23 years old as an architect. I wasn't licensed, but I was in an architectural firm funding a retirement account. I didn't have 10 grand in the bank and I'm putting, 10% of my paycheck into an account I can't touch until I'm 60. That's pretty stupid. I'm in the smallest tax bracket of my life. I needed the money then, and I'm giving my money to Wall Street, paying fees so the market can take it up and down, hoping that the account goes up, hoping that taxes go down, and hoping that I live to the age of 60 and can enjoy it. It was a horrible decision. So the principle is I need to take care of myself and protect the what ifs. Then I invested myself into a savings account until I have a bunch of liquid. And then I learned how other people's money works. And so I set up accounts that I can leverage over and over and over and over again, way before the age of 60. It's that easy.
And I know you have a online program for this, so but maybe just like a 30-second clip, like what do you think the what ifs bucket should be as far as savings goes? Should it be 6 months of savings, 6 months reserve, 12?
Yeah. So, Dave Ramsey likes to talk about a safety fund, emergency fund, he calls it. I call it an opportunity fund. Because at the end of the day, I don't care about putting my money into to the market that can maybe get a 20% rate of return when that same dollar could maybe go down 20%.
Right.
It's not going to help me. So when is a bank 0% rate of return a really good thing? Well, like last year when the S&P dropped 20%, all of a sudden zero looks really good.
Yeah.
So before I start even thinking about that, I would put money into a savings account, and I want to have about 3 to 6 months of my income saved in there, knowing that not my bills, 3 to 6 months of my income in a savings account. And then I want to start looking at other products to leverage. And that's where we use life insurance because it takes care of my family if something happens to me. I have guaranteed growth inside the policy. The government loves it. They don't tax the growth, and I can leverage it for investing in things like a 401 cottage or a rental property, which is where you come in.
It's funny, man. Like, I'm currently pulling up when I think of nest eggs and savings. There's actually, I took a screenshot the other day of the national average of home appreciation values. And if you look historically, since the beginning of when they've been keeping this statistic, I believe they started in the early 1940s. On average, through all the different markets, on average, homes appreciate year over year by 5%.
Yeah.
And if you want to look at security, one of the best ways to secure yourself financially is to invest in real estate. People want to pinpoint in and read all of this mainstream media nonsense about, oh, the market's going to crash, the market's going to crash. Well, I mean, there's statistical evidence that that's only happened twice. And when you look at what the rebound was for that, like in 2021, for example, homes appreciated by 19% nationwide. Some markets, it's even more than that.
Well, we're in Nashville, and it went way up.
And so, like, when somebody wants to talk about, oh, well, what happened in '08 could ever happen again, the reality is the numbers just don't dictate that. There's two reasons that the market crash happened. The first was basically if you could fog a mirror at the time, you could get a home loan. There just wasn't.
I think everybody's seen The Big Short. If you remember
Yeah.
the no income, no job loan,
Yep.
ninja
Yeah.
loan.
Yeah, I think there's like a scene where a stripper is talking about, like she
I
has
had
like,
5 houses in a college.
yeah, yeah, and that like,
Actually, in that scene, I don't know what I was
well,
thinking.
I'm sure there was some Hollywood in that, but that was true. I mean, there just wasn't any regulation. Well, then CFPB came in. The reality is there's just so much regulation now between Dodd-Frank and all the different stuff. The regulatory bodies to get a loan, I mean, anybody who's been through that process knows traditional finance now. There's a lot of checks and balances in place to secure someone financially. We're not going to have the default rate that we used to have. Also, most people who are sitting on a mortgage right now, I think it's like 25% of them have below 3.25, and over half of homes are actually paid off. There's a lot of really fascinating statistics that just show the financial security of homeowners in today's market.
Well, let me give you my perspective of that too, because I value what you just said. If you look at a stock can go to zero. A business can go out, right? It can go to zero. Property can't go to zero. And here's my thesis when it comes to real estate. I think in 20 years, people are going to want to sleep inside.
Right.
I don't think people are going to want to go camping for every single day of the year. And because of that, I think people are going to want to visit and buy and own or rent houses. It's not going to go away. And there's a finite amount. I think there's so much, when you look at the market volatility of stuff, the market will go up and down, but real estate can't go to zero. And the beauty of it is that it's an asset that, like, if you were to compare it to the market, like, it pays dividends. Renters pay rent, so it can pay you, and the government. If you ever want, I talk about this all the time. Is the government incentivizes what they want? They incentivize mortgages and business debt. So if you want to learn how the rich avoid taxes, invest in what the rich invest in.
Debt.
Debt. They're not doing a 401. Warren Buffett doesn't have a 401k. Postponing that money inside of a retirement account, hoping that it goes up, and then delaying a tax bill. He's quoted as saying he pays less in tax than his secretary because his secretary earns ordinary income. He's living off of growth of assets, which is a much lower tax bracket, or debt.
Yeah. So, I mean, once you look at, kind of like what we were talking about as far as, default rates being low, the other thing is inventory levels at the time. So if you look back in 2008, inventory levels had around 2.4 active listings on the market.
Wow.
So just ton of surplus of homes. Today's market, I think last time I looked at it, it was like sub 500,000 active listings at the moment. There's no inventory. If we woke up tomorrow with a million extra homes, we still would be short of where we were compared to in '08.
So is that what's driving in the interest rates? Because the demand is there?
So I think, no, it's more the Fed's trying to fight inflation, which is another reason. So, and this
Maybe they
brings up
didn't give a couple $100 billion to another country, then We wouldn't have to worry about that. Or trillions of dollars to COVID. Because the old saying, if you give everybody 10 grand, the people who are wealthy now are probably going to be wealthy later, and the people who are broke now are probably going to be broke. We just saw it happen. The government gave out all that money, and what happened to it?
Right. People who don't have faith in the US dollar and what's going on in the government need to buy real estate. And the main reason why is just like you said, it's a commodity. It's one of the few things where you can invest in it and it actually fluctuates with the inflation and where the US dollar stands.
Hmm.
Unlike gold and other things though, you can't rent out gold. You can't live in gold, but you can live in a house.
Yeah.
You can rent out a house. It's one of the few things that allows you to do that. And there's a lot of really cool lending products that allow you to leverage yourself a lot further with homes than what your traditional W-2 income would be. And I know that's, one of the things that you and I have chatted about previously is, how can you most efficiently buy a home? Because it's a pretty big misconception that in today's market, you need to qualify on a traditional sense. When it comes to W-2 income and I need to earn a certain amount of income in order for me to qualify. That's not the case anymore. There's a really cool product. There's actually a few different products out there, but probably the one that is the most exciting to talk about is known as a DSCR loan.
Yeah, that's what I
Um,
want to get into today because I don't. This isn't going to be an hour podcast for everyone listening, but I want to get into that DSCR loan because that really excites me. I think I had no idea this thing existed.
yeah, man. Well, and then we can sum it up pretty quickly. This is kind of like sniper shooting here. Once you have the information, it's pretty easy for you to put it into use efficiently. So, DSCR stands for debt service coverage ratio. In layman terms, what that means is does the property cash flow? So we'll break that down a little bit further. So,
This would be like for a second home or a
right.
rental property,
In,
not
in order, correct. So a primary home is required for you to have with most lenders first. So it is important that you discuss, if you're not currently a primary homeowner, that's the first thing that we need to focus on is getting you, a primary residence. And then a DSCR would be for things like secondary homes or investment type properties.
cool.
Once you are looking at DSCR loans, what's cool about this is no income is required to qualify. What we are looking at is does the property cash flow? And banks are typically looking at how well the property cash flows. So, for example, let's say that when we run the numbers for PITIA, so property taxes, insurance, basically escrow, principal, interest, all of those things. Once we have that number, let's say if our monthly payment comes out to be estimated at $1,000 a month, what we're going to do is we're going to send out an appraiser to assess the value of the home,
Mm.
but they're also going to check what gross rental income should be in that market. Typically, what they want to see is a 125% increase or a 1.25% ratio of whatever the monthly PITIA is. So, for example,
Give me an example.
if let's say on the same example, your monthly payment is $1,000, we need rent in that market to be around $1,250. Does that make sense?
Yeah.
And so, as long as the property is cash flowing, that's the only criteria that the bank is looking at outside of is the value there? Do you have the payment? And does your credit score align with what it is that we need?
Do I have the payment? But that would be from the rentor.
Correct. No. Do I have the down payment?
Oh,
So
the
the down payment for the property. So on these properties, in most cases, people are going to need to put somewhere between. It depends on if it's a secondary or an investment, somewhere between 15 to 30% down, depending on the lender and what product it is that you're talking about.
This is beautiful. This is why I get so excited because the down payment people typically think of as cash, right? When they do a DSCR, do they look at all of my debts?
They don't look at any of your debts.
They don't look at any of my debts. So when I use my family bank rather than the local bank down the street, my family bank has dividends and guaranteed growth, typically much higher than what a bank savings account would have. and I can borrow against that with no debt service and use that as the down payment. So I don't have to make payments back to my family bank, but that can be my down payment for my rental property or my 401 cottage, and let the renters pay me back into my family bank as I want. After I pay the mortgage, everything extra goes back into the family bank. This is really cool. We're going to have a lot more on that topic of how to buy a 401 cottage. I think the younger generations, because of the transparency that you see, and because of things like Airbnb and VRBO, where it's so much more accessible to rent cottages. Like when I was a kid, my parents would rent a cottage. They'd have to go through a rental agency. You'd call they would fax you a photo of like what the place looks like. Um, Sometimes they'd email you, but as a kid, they didn't even have email back then. Now you can just go on your phone and look through the properties. It is so much more accessible, and I think people are going to be looking for. I don't want to do a 401k, and then they learn what a 401 cottage is, and we're going to lay that out and exactly how to get it, because the way you structure that deal doesn't have anything to do with your income. Now, what
100%.
about this though? With rising housing prices, are you seeing DSCRs getting more scrutiny because it doesn't cash flow to that 1.25 ratio?
So the best thing that I can tell you is when it comes to lending, an interest rate is only going to be as good as what it accomplishes for you. And the reason why I say it that way is this is going to be a good fit for the right properties, and so it's important that you're really doing your due diligence in making sure that those properties cash flow. But with the right legwork up front, and I think that you can help us come up with a really solid strategy for doing that. You and I just need to get on a whiteboard together and really draw out kind of like what that needs to look like for
Hmm.
people.
Hmm.
Because I think a 10-minute analysis would tell somebody, okay, this is a good property or this isn't. So it's just a matter of us going through and cherry picking the right properties. But I mean, at the end of the day, most people are like, oh, well, the interest rate is this or that. I mean, do you care if an interest rate is 12% if you know that it's netting you out 3 grand a month?
No, nobody cares. Anybody that understands money should not care about that, because what you're gonna. And this is my prediction of the housing market. If and don't take this as gospel. This is my thought. I think that the housing market is so high right now because they can. To your point, there's low inventory. It's slowing. The purchases are slowing down. So mortgage people and realtors are feeling the hit because rates are so high. The consumer is coming from a place of greed, because 3 years ago you could go buy a rental and double your money every month. You'd make twice what the mortgage would be every month on a rental property because the rates were so low. My house is a mortgage of 2.75. I'm not going to refinance that ever.
Never, never.
And so when I think people get greed, so I think what you're going to see then is if rates come down, you're going to see a massive flood to the market. So the price of the home isn't going to go down at all. It might even go up because the cost to own it is going to be less because of the rates. So even if I don't, so what I'm saying is I don't see a housing market crash anytime soon. I think it's going to be level, and if not, probably go up.
Yeah, I mean, and I'm not a financial expert like you when it comes to economics and things like that. But basics of breaking down, that I feel like I'm stumbling over my words here a little bit. But when you look at where inventory levels are, I just don't see the trajectory in favor of a market crash. I
No,
mean, there's just not enough inventory for that to happen. Supply, demand, this is
no.
really what I was trying to say. Supply and demand 101 would indicate there's no way that that happens.
The sad part is millennials are having a hard time buying a house because the average house price is so high right now. 400 and some. I heard the average house price is over 400 grand. And who's buying the housing is, I mean, if you want to Google BlackRock and their single family home portfolio, that's an interesting read. But you're seeing people buy second, third, fourth, fifth houses more so than you see a first time home buyer because the prices are so high.
And my mom asked me the other day if we were investing in a 529 plan for our boys, and I told her, "Hey, mom, hot take, we are not."
You don't want a
But
government controlled sponsored plan for the kids, huh?
so I told her my goal for the kids is for us to acquire enough property for them to have a portfolio and then be able to leverage that, however it is that they choose to do. I mean, if they want to go to college, what we'll do is we'll do a cash out refinance or take out a home equity line of credit on those properties, and do it that way. Or, if the properties are cash flowing, maybe we just direct that cash flow towards whatever they want for their education to be.
Maybe you buy a
Um,
property in the college that they want to go to and have
yeah.
her get two or three roommates to help pay for the rent.
Ooh, man, and I'm not even ready for you and I to rabbit hole down this, but so here's the thing that I'm most excited about for my kids when they are at the age to buy a property. FHA loans. Have you ever heard the term house hack before?
No.
House hacking is one of the first things you should do, even before, like if you're thinking about getting married, do this first. Go out, get an FHA first time home loan, put 3.5% down, and buy a duplex. What you can do is you can actually buy a duplex qualifying for only 3.5% down. They'll let you qualify for the property off of the rental income of the other side of the unit.
Mm.
So, for example, I had a client who their max budget was 250,000, and he was like, I want to stay around this payment. This is what it needs to be. And at the time, I think he wanted his monthly payment to come out to be like $1,800.
Mm.
And that's when I asked him about house hacking. And he was like, well, man, that sounds really cool. And it just so happened that we found a duplex that was a new build. They offered 3% seller concessions to cover the closing cost. So literally all he had to come to the table for was his down payment. It was like, I can't remember exactly what it was, maybe like $15,000 out of pocket that he put down. He bought the duplex. He rented out, the monthly payment with me was going to be $2,800 a month. He rented out one side of it for $1,900, and then he got a roommate for another $900 a month.
So what was he making then? He was making money on that.
He was making money on the house.
That's house hacking.
I mean, he was living in it for free, and the plan was, he was like, how can we copy and paste this again? And I was like, well, here's how you do it. This is why you don't get married first. Before you get married, go get your girlfriend, fiance, whoever it is. Do the same thing. Now, instead of you having just one unit, you have 4 units.
Wow.
And you've got a portfolio. Yep.
Wow. That's incredible.
Yeah, I know that's not what this podcast was about, but it's one of the things, like if we're talking about for young first-time homeowners, if there's anybody in here, like if DSCRs isn't what you're really, in the market for right this moment, talk to us about house hacking.
Well, I think anybody listening, I think I love talking about the DSCR. The house hacking is a cool little trick. The people listening are the ones that want to invest in themselves. So whether they're buying a first-time home or their third rental, I think the DSCR is going to be some value there. We got to wrap up here in a minute. I think this went really well. I want to do this again. So let's call this part 1 of our conversation. Before I let you go, though, what any final thoughts or give me your vision. What do you see Skyway Financial doing in the next call it 5 years?
Man, so I'm so excited about the direction of where we're headed and kind of the trajectory. I think that big picture, what I look for us is a lot of growth, a lot of opportunity to bring on other excited entrepreneurs. So, if there's anybody who's interested in getting in this space and you're looking to, step foot into the professional side of lending, we're looking for people to be able to give them an opportunity like I had. The groundwork for somebody who maybe doesn't have the experience, that it takes to kind of do this, I want to pay it forward. We've hired, a couple people, and I've trained them on. And to be honest, I've felt more rewarded from that than any commission check that I've ever gotten.
Yeah.
So, that's really what I'm excited about for the next 5 years is, overall growth and just bringing on other people to help them build out their dreams and achieve their goals. But then if we look kind of more on a smaller scale, I'm really excited to see the filtering out of some bad loan officers. This sounds horrible. If we look at This is a fun statistic. So in 2021, there was 179,000 loan officers. Guess how many there are today?
You told me this, so I'm not going to answer. 120,000.
No. So it at the beginning of this year it was 93,000.
Mm.
At
That's
the end of this year,
45% of the market.
at the end of this year, it's supposed to be closer to 80,000. And that's because there got to be a point where loans was order taking. And so you had a bunch of bad people get into this industry who offered up bad advice.
Yeah.
And so, as we're kind of wrapping this up, and maybe the best way to end this would be for me to say, if you're trying to get in this space, you need to surround yourself with the right people and really vet them out, because there's a lot of bad loan officers. And thankfully, this market has kind of weeded out a lot of the bad ones.
I'm going to say right now it kind of did that, didn't it? 40-some thousand people that are out now.
But it's expected to be worse over the next 6 months.
Wow.
And so I'm excited about seeing the market share shift to the loan officers who deserve it. And I think going into Q1, Q2, because if Biden wants to get reelected, he's going to have to come in. I think he's going to do two things. I think he's going to ask the feds to lower interest rates. And then I think he's going to have to do something with oil prices, because, gas prices, groceries, interest rates, all that stuff needs to be the main focal point for whoever's going to be elected next. And I think that's pretty glaringly obvious at this moment. So,
Our statistics since he took office, inflation's up 20%. And we feel it when you go grocery shopping, man. It's crazy.
yeah.
So that's why we do these podcasts, though. The best way to help yourself out of where you are is understanding that you are your biggest asset, and taking control of your income is the first step into making that a better life. And then understanding the financial principles, and finally finding the tools that you can use to go buy assets that you might have thought you've never owned. Never thought you'd own 2, 3, 4 properties. And if you start just following the rules, you can do it. But it starts with the mindset. So thank you for your insight on the mindset. But yeah, I say we do this again. What do you think?
Love it. I'd love the opportunity, man. It'd be a great call for sure.
Love it. Cool, man. Well, I'll put a link to Austin's website, Skyway Financial, in the description. Everybody, thanks for listening, and we'll see you next time.
See you guys.